Welcome to the STR Data Lab.
Hello and welcome to the STR Data Lab. I'm Jamie Lane, Chief Economist at AirDNA, and I'm joined today by my good friend and colleague. We have Bram Gallagher. Bram, welcome back to the show.
Thanks for having me, Jamie. Always a good time.
So we're here today to talk about the December U.S. review, how we ended up the year for 2025. So I'm really excited to dig into some of the end-of-year trends because, man, Bram, it was a wild year for short-term rental performance. And who could have predicted how we would have ended up the year given how we started?
Well, I would say that our outlook was pretty accurate at the beginning of the year, although a lot of things came together to make that happen.
Yeah. So I want to start with just and maybe what stood out to you most in the December short-term rental data, and then we'll get into some of the year-end performance. So I know some of the broad metrics and what stood out most to you.
Well, demand has been weakening, and, we had really, really strong pace going into December for the holidays. Now, some of that was going to be in January, and we knew that. But demand nights actually came in around plus 2.1% for the month of December, which is decent, but, not quite as high as I was expecting. But on the plus side, our ADR lifted 3.5%. So finally broke through the inflation ceiling, I guess. We've got some real gains in ADR. So that was impressive. So, whenever you see something like that where the occupancy is not quite as strong, but then the ADR is pretty good. And then that has helped out sort of revenue and that's for the bottom line. So it was a little bit different than I anticipated for sure.
Yeah, no, I suspect some of the timing around New Year's Day and New Year's Eve and helped. And I know in my property, we got some great bookings at the end of the year around the holidays. And people were willing to spend money. So to get those top properties around New Year's. So that's pretty exciting. I was a little disappointed as you were around the weakness in occupancy. So 2.1% and supply grew by almost 4%, 3.8. So we did see an occupancy decline for the month of 1.7%. Slightly better than last month's and negative 2.1%, but and still that and we ended up the year with 4 consecutive months of declining occupancy, save for August where it was only up 0.1%, and that's essentially 7 months of declining occupancy. So given where the first half of the year started at 2% growth in occupancy, we ended up the year, the second half at minus 1.2%. It seems like it was a tale of two halves in terms of industry performance.
Right. Yeah. We had been talking about that theme right before we started recording, but that's very true. So at the beginning of the year, way back when I, had the outlook, I said occupancy was going to creep up a little bit. And I started getting really worried at the beginning of the year because we were blowing it out of the water. But luckily, we had a poor last half and it balanced out. So our year-on-year occupancy is up very, very slightly, about 0.2%, but about the same. But to your point, yeah, the first half was roaring, and that's in terms of not just occupancy, but also rate was very strong and sort of weakened out, and then of course the RevPAR night and day declined slightly in the second half, up about 5% in the first half. So, really, really disparate performance. A lot of that, I think, has to do with softening labor and, some of the fallout from some of the trade policy. And there's a little bit of uncertainty around inflation and what interest rates are doing as well.
Yeah. So give me a rundown of what we have seen in terms of the economic data released in the past month.
In the past month? Well, yeah. So December jobs, they were not as strong as we would have liked. Correct me if I'm wrong. It was around 50,000 new jobs added. And because I don't have the numbers right in front of me, but, unemployment ticked down a little bit. Labor force participation also ticked down a little bit. So, yeah, I've sort of couched increases in the unemployment rate with increases in the participation rate before. So I'll couch this sort of decline as well. So yeah, labor market is holding very steady. Right now it's a very icy. Well, it's an icy time outside. It's icy time in the economy as well. So the housing market is frozen. We saw pending sales decline rapidly in December. The labor market is very chilly. It's hard to find a new job, although there aren't big layoffs happening, so that's good. But that also means that people aren't changing jobs as often as they have in the past. And changing jobs is one of the ways that people increase their wages significantly. So whether it's finding that better fit or just sort of reinvigorating their career or what have you. So that process has slowed down a little bit, and I think it definitely is reflected in some of the performance in the STRs.
Yeah, no, I think that's right. It was, I think, a little. It was nice to see that the employment rate did get revised down a little bit from what we saw in November. So the acceleration that we had been seeing gets tempered a bit, and maybe not as worrying than as we were looking at it last month of 4.5%. Our friends at STR on the hotel data side just shared with me their year-end performance numbers, so I thought I'd share that briefly. Like short-term rentals, it was a very weak half of the year, and as I said, we essentially saw 7 consecutive months of declining occupancy. The hotel industry's actually seen 10 consecutive months of declining occupancy. So January and February started positive, and then every subsequent month has been negative. December ended up about down 1%. ADRs were up roughly 1%, so that put RevPAR decidedly flat, and essentially flat for full year 2025. So average hotel earned essentially the same amount of revenue as it did the year prior, with occupancies down almost 1%, ADRs up almost 1%. So the weakness was really felt throughout the country for both hotels and short-term rentals.
Right. I've been poking into a little bit of our Calibri Labs data, our data partner for DMOs. And yeah, we've definitely seen so much weakness in hotel, especially in the group segments. And then the demand that we are seeing picked up often in the discounted segments. So clearly some pain in the hotel industry.
Yeah. So maybe talking about some of those 2025 themes. I loved the sort of breakdown you did in the report of talking about sort of the and disparate performance throughout the year, price tiers, location types that sort of under or overperformed. So what stood out to you there?
Well, there's several things, but since we've just been talking about kind of that level occupancy growth, what really struck me is that, yeah, you take the average occupancy for the US and it's about the same in 2025 as it was in 2024. Of course, you ask any operator, and then it's very likely that they will say, no, my occupancy changed in the year. And that's exactly what we saw when we start digging into the data, that while the US as a whole occupancy was level, look at the top 50 markets, 25 of those had increasing occupancy, and some of them, very high increases in occupancy, and then the other half decreasing their occupancy. So it really kind of masks the dynamic, because you've got a lot of have and have nots in terms of markets, but also in terms of individual operators as well. Things that we looked at was people that have been in business for the last 2 years, how their occupancy has changed and what the spread is. The center, the average, of course, is right around 0, but there are lots of people, as many as 10% of operators last year had occupancy losses of 20% or greater, which is, mind blowing, right? That's huge. Of course, about 11%, will have 20% or greater occupancy increases. So, on the plus side, that's really good. But then you've got some performance that's doing really, really well, like plus 20% occupancy, but then you get the minus 20% occupancy balancing out over here. So there's a lot of dynamics. As far as the markets go, San Francisco having the biggest occupancy, and that's been a trend this year because of, I think, some of the tightening regulations, the difficulty in putting new short-term rentals in San Francisco, but also a lot of the coastal resorts very well represented. So resorts actually did pretty well this year. So leisure travel was definitely king as far as we had. So places like Panama City, Santa Rosa, Rosemary Beach, Gulf Shores, Mobile, Destin, Fort Walton Beach, all of these with pretty sizable occupancy gains. We're talking about coastal resorts and mountain resorts too. Those also had the biggest ADR gains as well. So coastal resorts over 3.5% ADR gain, mountains, lake resorts about 3% ADR gain, and then all the others, much smaller. So mid-sized city only about 1.5%, small city 1%, large city urban even down 1%. So it's a tale of two halves, not just in time, but it seems like also in performance. You've got some locations that are doing really well and some that aren't. Some markets are doing pretty well and some are not as well. And individual operators.
Quick question there. Does the deterioration in ADRs and pricing power surprise you for what we saw throughout the year?
No, because I think there has been something of a comeback as far as urban supply goes, but not necessarily urban demand. So I think the pricing struggles that we've seen in the urban centers is not overly surprising. And of course, something else is that we did see inflation. It was trending down. It has started to trend back up a little bit with some of this, new tariffs and all that. Now, I'm hoping that is essentially over. So many economists are theorizing that's a one-time increase to prices. So it caused inflation during 2025, but hopefully that should simmer down. But we do know that the contemporaneous effect of increased inflation is often that when people start pinching the budget where they can, and leisure travel is one of those places.
Yeah, so I know we track the data by price tier, and the K-shaped economy has been a theme throughout really the broader economy, right? Where we see lower income consumers pulling back. We see higher income consumers really pushing forward and spending more. A large part of the overall economy now being driven by those higher end consumers. So is that a trend that you saw play out this year? And is it actually continuing in November, December, and at the end of the year, or did we see any maybe trend back towards more normalized performance across the price tiers?
Right. And I think I know which chart you're referring to. I know you don't like too many bars in a chart, but this was very, very striking to me. So I had to include all the months individually. But yeah, to your point, the K-shaped economy. So, the wage growth is not as strong as we would like, and that tends to hurt lower income folks. And inflation tends to hurt lower income people. Meanwhile, the stock market had a great year so far. Yesterday notwithstanding, but generally speaking, it's up. A lot of wealthy people becoming wealthier, sure. And if we look at the performance and divide out short-term rental occupancy change by those price tiers that we've set up between budget, economy, mid-scale, upscale, and luxury, in every month except one, the luxury has got the largest increase or the smallest decrease year over year. The only exception is March because we had our big Easter spring break calendar shift, which kind of made March sort of an outlier. But, the beginning of the year when our performance was strong, luxury occupancy was going up the fastest. So whereas, we might have been going out 5% on average, the luxury would be going up 9%. And then we go to the end of the year in December, luxury now is the only rate category that's still increasing its occupancy. It has a very slight increase. Meanwhile, budget is down 2.6, and you've got luxury slightly up. So, and that's true for every single month, which is, I think, which was shocking to me, which was, astounding. It's that consistent. In most of these months too, there's a really steady grade if you look. So the budget, which is the lowest scale, up to the luxury, which is the highest scale, the ordering is just like that for most of these months. There's a few exceptions here and there, but luxury is definitely always on top. So we've definitely seen the K-shaped economy show up in the short-term rental market. So if you're thinking about maybe starting your own short-term rental this upcoming year, because it is a great year, I think, for investing in the short-term rental industry, you may think about positioning yourself maybe towards a little bit higher end rather than the lower end.
Okay. And 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 maybe that's a good segue to talk a little bit about supply, because supply was the big theme of our 2026 outlook report. I think your forecast calls for 2026 to have some reacceleration in supply growth. I know we've seen some movement on mortgage rates over the past couple weeks. So, and is there anything that stood out to you in terms of and how December ended up, and maybe how the beginning of 2026 might play out in terms of supply growth?
Well, of course, the big news, and we've got to apologize to all of our readers and listeners, but I did finish up the copy on this 6 days ago. So, in this day and age, 6 days is a long, long time. But with this last interest rate cut that Jerome Powell and the Fed put into place, we saw mortgage rates decline as well. So previously had been around 7%, declined a whole point to 6%. And it doesn't sound maybe like a lot for people not used to working with mortgages, but that can definitely mean a lot of savings on your payment, more payment towards your principal and less towards interest. So, that has been very impressive. We've also looking at occupancy stabilizing, that's really a good sign because you want to have your cash flow stabilized as well. We saw a little bit of additional movement as well. So with Trump himself wanting to support affordability, so affordability has been, it's been a real watchword since I guess the COVID outbreak, when we saw a really dramatic increase in home prices. Home prices shooting up maybe as much as 25, 30% over a very short amount of time. And they haven't gone down back to their pre-COVID levels, but they've gone down a little bit off of the peak and they're continuing to decline. So, we're starting to see maybe some glimmers. And again, Trump even wanting to help out with affordability by announcing a $200 billion mortgage-backed security purchase by some of these government-sponsored enterprises, Fannie Mae and Freddie Mac. Just to put it in context, I guess the quantitative tightening or what the Federal Reserve has been doing to increase rates, selling off some of these mortgage-backed securities, about $700 billion in the last 3 years. So this definitely wouldn't completely offset that, but it did have a momentary effect on the mortgage market, driving mortgages very briefly below 6%, which we had not forecast in Oxford Economics. Both of us were expecting mortgage rates to stay about 6.1 and maybe stay that above 6, certainly for the entire year through 2027, in fact. So the fact that it briefly went down there was exciting. You've brought it to my attention, though, that maybe my excitement was a little early. As
I don't think you could have predicted the increased volatility that was going to come with our latest rebel rousing around Greenland and NATO, and where we saw in 10 years treasuries spike again back up to 4.25%, and mortgage rates on average sort of moved back up to the 6.2 that we saw before the announcement around the buying of the debt. So,
and I think both of those were a bit anomalous. So if you were the one to lock down that 5.99 rate, that lucky you did great. But and don't sign a mortgage today, maybe, because Trump's already starting to walk back some of the rhetoric on Greenland, saying he won't take it by force. So I'm hoping we've avoided a war with Denmark, and markets will calm back down as they realize, well, okay, this is we're not going to be spending trillions invading Greenland. Perhaps I'm still thinking it's going to be staying above 6, but that 6.1 seems more natural. So I do think that that's going to be going back down. And this mortgage-backed security buy, once it starts, actually occurring and trickling through the economy may help with that, keeping it close to 6%. So you've got, I guess these two factors: declining house prices, declining mortgages, stabilized occupancy. It's a recipe for investment success.
All right, you convinced me, Bram. Um, so, and that's a great and sort of an outlook or at least understanding of what we might see and have seen and might see going forward. Have you changed any of your thoughts on how many interest rate cuts we might get from the Fed in this year?
Well, people are starting to anticipate fewer cuts. I've seen there's some market doubt about the speed of cuts. Again, inflation is, it's not exactly where we want it, and it's not moving in the correct direction very quickly. So, I think Jerome Powell is going to be he's going to be very careful about this. He's definitely stressed his independence from Trump and how important that is. He took a really unprecedented step in doing a video response to Trump. So saying that he's going to stay in his position, he's going to do the best he can to keep, to keep the double mandate of high employment and low stable prices in mind. But I think there's definitely still some possibility there because the labor market is still on sort of difficult footing. If we get some of this tariff inflation behind us, so if it really is sort of a one-time thing, we don't have further escalation from aggression with Greenland or what have you, then I think that we could see some natural pressure on the inflation rate, taking that down, which would give the Fed a lot more room. So I wouldn't totally count out additional cuts, but I do think that there is some talk of being more careful in the immediate future. Nevertheless, even if we were having that accelerated schedule of rate cuts, we weren't expecting further rate cuts to have big effects on the mortgage rates in the near term. So, there's a transmission process that these short-term rates have to go through to get to the long-term rates, and we think that right now the short-term rates they're somewhat uncoupled.
That makes sense. So maybe switching gears and looking at the future. So I always love in the U.S. review where we dig into the pacing data, try to get a sense of where things are trending out of the next 6 months. In reviewing it, it does feel like things are going to stay a little weak in January, February. So pacing, and slightly up on the demand side, but not, and I think anything to really get too excited about. Maybe that it's not negative, but the 1.5 to 2% demand growth that we're seeing is probably still going to lead to declining occupancy levels for at least another 2 months. But then, as of now, it looks like things are pacing pretty well for March and April. Sort of the return of spring. Looks like spring break travel is pacing pretty well. And then some big acceleration heading into the summer. So, what have you seen digging into the data, looking at forward pacing?
Yeah, I think people are really excited about spring break. Certainly, I've had people asking about it. I've seen a lot of really high pacing numbers for March, in particular in a lot of these sort of beach areas on the west coast of Florida, for example. There's other places too. Fort Lauderdale, Miami is doing really well. Los Angeles is up about 11%, recovering from wildfires in January of last year, as far as their pacing goes. So, I think people are really excited. It's been a chilly winter. That's definitely on people's mind. But what was really striking to me is the June numbers up 25%, 24.2% year over year. So people already starting to think about the summer, whether the World Cup is playing into that. I'm sure it is. But that's pretty exciting to see. The lead times, which affect pacing, as you well know, they've been in free fall for the last couple years. It's the most frustrating trend in short-term rentals for operators is that shortening lead time. I'm buoyed to see that over the last 3 months, we have seen lead times either increase or stay exactly the same. That's inclusive of December. So some of these, pacing numbers, I think if that were to hold, these pacing numbers look pretty strong, right? Because we're going to be having our lead times. They're not shrinking anymore, which tended to understate our pacing numbers, I guess. And now they're going to be, I hope, more accurate. But that's definitely something that we're looking out for, is that really that strong summer performance is already on the books, as well as really exciting sort of spring break anticipation, particularly in the resorts, I should say.
Yeah, and it does look like a lot of those markets that you've called out are I'm sort of centered around some of the more traditional vacation beach markets, a lot of Florida markets in there that seem to be trending well for spring break travel.
Yeah, and who knows? We're getting a big winter storm, so we might see a little bit of boost in January, February from the eastern ski markets.
Yeah, and that's something we still need to dig into more on what the impact has been so far this year on the Western ski markets as well, with the and many markets I think still hoping for snow.
Right. The hope of snow.
I know I've got my fingers crossed for this weekend that we might get something. I know my kids do.
Oh, right. Well, Atlanta snowstorm is just ice and slush mostly, but we'll see.
Yeah. So, Bram, this was a great overview on December and sort of what we're seeing so far in early 2026. Is there anything else you want to highlight on the month?
Uh, the only other thing I would say is I'm just really excited to see the Super Bowl in Santa Clara. That's coming up. Uh, Santa Clara hosting not only or two big football events, the Super Bowl and the World Cup. And I've been talking to some reporters from the Bay Area, and they're really excited too, because it's not just Santa Clara, but also San Francisco, San Mateo, other places in the Bay Area. They're actually seeing a little bit of a bump from the Super Bowl. So we're seeing about 100% pacing demand increase year on year, and about 70% higher ADR for the San Jose Palo Alto market. So it looks like it's going to be a well performing Super Bowl, right? So the Las Vegas Super Bowl, we didn't see increases in ADR nearly this high because they're sort of well stocked in short term rentals as well as hotel rooms. New Orleans, we kind of saw the opposite, because the New Orleans downtown very compact, and we've got a sort of a small set number of short term rentals, and then we've got San Jose Palo Alto kind of in the middle. So we're going to see good performance, but we're still seeing some availability for people that want to go see the game, and of course visit the Bay Area. So that's going to be a lot of fun.
No, that's great. Interested to see. Do we know the teams yet for the Super Bowl?
You know what? I don't follow the teams. I just love to see the biggest game of the year. I'm one of those people.
You've got two people talking about. It looks like it is still to be determined on what the teams are. So maybe we are yet to see the big amount of bookings coming in once the teams get announced. So, Bram, thanks so much for running through the data with me. For those following along, this was our first review of the year. We do these every month where we run through the numbers. If you want to stay on top of all the latest trends in the short-term rental industry, please subscribe, and we'll keep you guys updated going forward. So thanks, Bram, for joining once again. And then there'll be a link to this month's review in the show notes. Thanks all.